My name is Andy Boynton. I'm the Dean of the Carroll School. I just have a brief introduction and a little bit about the school, what's going on, very little bit, and then turn things over to one of our main events, the main event of the day. Welcome to the 14th Annual Finance Conference. As an alum of Boston College, 1978, as a parent of a graduate of Boston College, I'm very proud of where BC is today. It's a very different place than what it was in 1978, and even very different than what it was 15 years ago. And I'm especially proud of our alumni in the finance community. Not all of you are alum. How many are alum in the room? I'm just curious. Quite a few. I'm proud of you, and very proud of our current students at BC. We have over 1,000 finance concentrations in the Carroll School, or majors, and that's the second largest, or basically the largest major on campus. We have about 2,200 undergraduates in the Carroll School, 1,000 of them are finance majors. But I'm also proud to say that we talk a lot, and we just had a discussion about some issues around learning and building personal capital and people capital. About 40% of the Carroll School undergraduates, and we really focus mostly, and that's not exclusively, but we really focus on the undergraduate experience at BC to try to make it a formative experience. About 40% of our undergraduates in the Carroll School also minor or major in the humanities or sciences. I'd love to have that number up to about 75%. We want our students to be broader, more curious, and have an appetite for learning. And I don't think they're only going to get that being undergraduate business school students. So we want them, they already have a great core curriculum at BC, but we want them to major and minor in humanities or sciences as well. I'm also very pleased, and a lot of help from Ronnie Sotka in the room, who's our finance chairperson and senior faculty associate dean. He was a big help on this project. A year ago, we launched minors in the Carroll School for arts and science undergraduates at BC for the first time ever. Now, they would take electives in the Carroll School, but now they can take minors. We already have over 1,000 minors. So we have English majors, theater majors, biology majors, math majors. 1,000 of them sit in our classes in the Carroll School with our students. And so we want very permeable, interdisciplinary learning at BC, and we're starting to achieve it. All good things. Of course, finance is the largest minor already. I hope they're not chasing past returns. In terms of the conference, I want to thank the co-chairs, a lot of conversations, a lot of emails, and a lot of great ideas from them on how to organize today. The conference co-chairs, if they would just stand as I introduce their names so we could give them a round of applause. Dan Holland, Lindsay LeBeau, Mark Seidner, stand up, folks. And Professor Jonathan Reuter, one of our star professors who's going to be with us later today. Thank you for your time in putting together this great day for us. I'm now going to turn things over to Mark Seidner, who will be moderating our keynote discussion this morning. Mark is the CIO of Non-Traditional Strategies, Managing Director and Head of Portfolio Management at PIMCO. He graduated from the Carroll School of Management in 1988. Mark?
Andy, thank you very much. Congratulations on everything that the Carroll School has accomplished, and not to rest on laurels. There's still plenty of challenges ahead. So don't sit down. Go out and go out and get to work. You've got better things to do than sit and listen to a conference. Can I stay? Yeah, of course. Yeah, of course you can, as long as you promise to ask a question. No, but seriously, thank you, Andy. It is my pleasure to introduce and moderate this keynote session, which is in recognition of the late Dorothy Margaret Rose Knight, for whom the session has been named, which will include a conversation with Mr. Robert Stephen Kaplan. When was the last time you referred to as Robert Stephen Kaplan?
I don't know. When I was in a lot of trouble.
Yeah. Rob is president and CEO of the Federal Reserve Bank of Dallas. That's a position he's held since September of 2015. He is the 13th such president of that institution. He represents the 11th Federal Reserve District on the Federal Open Market Committee in the formation of monetary policy, and oversees 1,200 employees at the Fed. Before joining the Fed, Rob was the Martin Marshall Professor of Management Practice and a Senior Associate Dean at Harvard Business School. Before joining Harvard, you are the author of many books on leading and leadership, which, as I said earlier, I've probably learned more about leadership from Rob than anyone else I've had the pleasure of knowing and working with in my professional career. Prior to joining Harvard in 2006, Rob spent 23 years at the Goldman Sachs Group, lastly as vice chair, head of investment banking, and head of investment management. And I think that's probably more than enough of an introduction for you, as far as
Plenty.
I know you like to keep it short and sweet.
More than enough, yeah.
I'll finish the introduction of Rob before we turn over to the discussion. By the way, the plan is for about 50 minutes of moderated Q&A, and then we'll open up to all of you with some roaming mics to ask your questions of Rob for about 20 or 25 minutes or so. So that's the plan, so start thinking about questions. But I can say that as a bond market professional, I rest much easier at night knowing that there are folks like Rob who are helping oversee and manage monetary policy in this country, and so thank you for that. And then lastly, I introduced Rob as the president of the Federal Reserve Bank of Dallas, president CEO, but it's also a pleasure to introduce you as a friend.
Yep,
So
absolutely.
thank you for
Mark.
joining us today, Rob. Why don't we start? It all starts with fundamentals.
And I will just mention, we have a number of advisory groups at the Dallas Fed. Mark is on one of those advisory groups, which he's agreed to do, advise us on shadow financial system, non-bank financials. And so I appreciate all the help that he gives to the Federal Reserve.
Well, it's an honor to be part of it. It all starts with fundamentals. Why don't we start there and maybe start at 60,000 feet or 30,000 feet, wherever you want to fly, and just give us a sense of your sense of the economic fundamentals in the U.S.
So GDP growth in the United States in 2018 was around 3%. I would say it this way: up until about 5 weeks ago, our forecast for 2019 was GDP growth in the range of 2.25%, maybe a little bit more, maybe a little less. So we thought we were going to slow from 2018 to 2019. And why? Fiscal stimulus waning. We had substantial fiscal stimulus, as you know, and some of that fiscal stimulus is beginning to wane and will wane through 2019. In addition, we've got a very tight labor force, and we would expect that new job growth is going to need to moderate because we've got such a tight labor market, and GDP growth is made up of growth in the workforce plus growth in productivity. So we thought that was going to be an issue. But the underpinning of the economy on the positive side is the consumer. Consumer is about 70% of GDP, and the household sector is in pretty good shape. Household balance sheets, it's one sector that's actually improved, deleveraged somewhat since 2008. Other sectors have increased leverage. That's one sector that is actually deleveraged, and the job market is tight. And so we've got a pretty good underpinning with a strong consumer. Now, the reason I say a little bit tongue-in-cheek up until about 5 weeks ago, so obviously trade tensions have heightened. It seems like a long time ago, but really since beginning of May, there's more questions as to what's going to happen with China, and then recently there's even more questions about what will happen with USMCA, the trading relationship with Mexico. And the reason that this latter one is a very big deal, and then we'll talk more about secular trends, but just to finish on this, the trading relationship with China is primarily a final goods trading relationship. Yes, there are some integrated supply chains and logistical arrangements with China, but the bulk of the trade deficit is final goods. The bulk of the trading relationship, on the other hand, with Mexico is intermediate goods. And what do I mean by that? Substantial amount of the imports to the U.S. from Mexico are goods that have been going back and forth across the border, have a substantial amount of U.S. content. This is a trading relationship that has allowed U.S. companies to domicile in the United States, add jobs in the United States, and allow businesses to manage their costs by using logistics and supply chains that help them lower their costs and remain globally competitive. And we believe, based on our research, has allowed the U.S. to take share from Asia, okay? And so if you put sand in the gears, potentially, of that relationship, that's gonna bite and really affect businesses. And so I would say, if there are downside risks to the economy at this stage, they're business oriented. In other words, I think the consumer is going to stay in good shape for some period of time. What I worry about is because heightened business uncertainty is having a chilling effect on CapEx, desire of CEOs to spend on CapEx, may ultimately feed in, if it lasts long enough, this level of heightened uncertainty, may feed into hiring, which in turn, if that actually happened, you may see that later this year into next year show up in terms of the consumer. So we're watching it very carefully. The thing I'd note, these tensions have heightened in the last 5 weeks. They could, whatever the opposite of heighten is, they could de-heighten in the next 5 or 6 weeks. And so in my seat, I think it's wise to let this situation breathe a little bit, see how it's going to unfold. But the trade relationship with Mexico in particular is so overwhelmingly in the interest of the United States. And oh, by the way, it is in the interest of the United States to come to some resolution with China also. But the trading relationship is so overwhelming in our interest, we would be hopeful that you'll see some additional actions over the next few weeks, which may de-escalate some of these tensions. But time will tell, and we'll have to see.
Texas seems a long way away from Chestnut Hill, Massachusetts. But since you bring up Mexico, and since you do represent the 11th district, which is Texas, Louisiana,
New Mexico.
Can you talk a little about the regional economy, about Texas, about oil, about perhaps, since you mentioned Mexico, about the impact that the tariffs might have on the Texas economy?
So let's take them in stages. So I mentioned aging population in the United States, slowing workforce growth. It's affecting the bulk of the states in the United States. And so how? I get a heat map once a month based on census data about current and projected trends in population growth by state. And what you'll see is 35, 40 states in this country are flat to down in terms of population growth and expected population growth. Texas is bucking that trend, and that the story of Texas is migration of people and firms to the state. So the population of Texas 10 years ago was about 22 and a fraction million. Today it's approximately 29 million, and it's our estimate at the Dallas Fed, believe it or not, that over the next 20 years, we're going to start approaching 40 million people in the state of Texas. Now, so to put that in contrast, I'm from the state of Kansas. What's the population trends in Kansas over that same period of time? 3, 2, 9, 3, 2, 9, 3. It's not unusual. Illinois, other states, basically flat to somewhat down. That has an enormous impact on the state, GDP growth in the state, ability of the state to spend on its priorities. And so this migration trend has led to dramatic diversification of industries and growth in major cities in the state. Dallas, Houston, San Antonio, Austin are 4 of the fastest growing cities in the United States, and we expect that to continue, to the point that Texas is the largest energy oil producing state in the country. If we were a country, we'd be the 4th or 5th largest country in the world in terms of energy production. But by our measure, energy production is only about 8.5% of the state's GDP. Okay, so the state has diversified dramatically, and so what we're seeing, we look at a measure of job growth, and job growth in the state of Texas looks like it's going to be 2% or more this year. which if you add productivity to that, would tell you that we're going to outperform the United States in terms of GDP growth. So there's a lot of, and in terms of the energy business, while you're going to see a lot of volatility in the price of oil, Permian Basin continues to increase production. U.S. Energy production, oil production continues to rise. But the decline curve of shale, may not be as familiar with the shale business, but the decline curve in the first year of a well in a shale well is as much as 70%. So what does that mean? You need dramatically more drilling just to keep production level, and to grow production, which we are, you need dramatically more activity. And so the long and the short of it, big oil companies are not spending on long life projects, okay? The bulk of our marginal energy production now is in shale, and to the point where the big oil companies have now migrated into shale themselves. Why does this matter? If you look globally, we believe we're in relative equilibrium globally with supply and demand. I know we've got the Iran situation and sanctions and waivers and all that, but we're ultimately in relative balance. It's our view at the Dallas Fed that shale, as prolific as it is unlikely to keep up with global growth and demand, okay? And if that's true, we still think that we could be just as likely 5-10 years from now undersupplied as oversupplied. This is why, and when you see some weakness in the price of oil, I think today it has more to do, in my judgment, with worries about a global slowdown, demand slowing, than it does with supply. But the point about our regional economy, we've got a lot of tailwinds, we've got a lot of things going for us. As a result of these tailwinds, we're probably made the most important decision we could have made in the state of Texas recently, which is to dramatically increase money spent on secondary education, pre-K, early childhood literacy. And that's a great decision, but we're in the good position to make those decisions because we've got population growth.
You mentioned education. I know it's a passion of yours, and we'll turn to some of the secular thoughts in a moment. But just as while we're on sort of the cyclical outlook, so then we widen out the aperture, U.S., Texas. How about the rest of the world and outlook for the rest of the world, and to the extent that it affects thinking at the Federal Reserve?
So the U.S. is less than 5% of the world's population. Something like 45% of S&P 500 revenues come from outside the United States. So if global growth slows, we're not going to be immune to slowing in global growth. And it's our view global growth is decelerating, okay? We know Europe is got a number of challenges in terms of sluggish growth. And emerging markets, and particularly China, they are much more sensitive to export, and a lot of these global trade tensions are probably disproportionately having an effect on them. Now, China is aggressively trying to stimulate global demand, grow their private sector away from state-owned enterprises. They've been heavily using increasing debt to GDP to stimulate that growth, either investment in infrastructure, you might say overinvestment in infrastructure, and investment in state-owned enterprises. But a lot of these heightened tensions are creating greater challenges for Chinese growth, emerging market growth. And so we think global growth is decelerating. And when global growth decelerates, all things being equal, it's going to have some spillover effects into the United States. And I think that is what's going on right now.
Great. You write frequently. You publish essays regularly. You tend to, in those essays, think and focus on some of the more secular trends. Why is your passion on the secular?
Well, I'm a business person. I'm not a PhD economist. I'm a business person. And as a business person, and there are many business people in this room, I'm trained in running a private business that profit is an outcome that comes as a result of structural decisions you make in your business. Who do you hire? Other strategic decisions you make. And so I bring that mindset into this job. And so when I look at the U.S. economy, I look at four big structural drivers. One of them I already mentioned, aging population, slowing workforce growth. That's number one driver. And to the point where a lot's made of the participation rate, the percentage of the population 16 and older that actually is participating in the workforce. That percentage has been flat the last 3 or 4 years, and that's been a great accomplishment. Even though, and as strong as growth has been, participation has been relatively flat, around 63%, a little above, a little above. We believe at the Dallas Fed over the next 10 years, it's likely to slip down to 61% because of aging, okay? So that's a headwind for GDP growth. Second headwind for GDP growth, or challenge, is sluggish productivity. And why? And we spent an enormous amount of time at the Dallas Fed, and we just had our second conference on it, on technology-enabled disruption, and the effects of globalization. And the reason we do that, it's limiting the pricing power of businesses, it's affecting the margins of businesses, okay? And so what businesses are doing to deal with that is investing even more in technology to replace people. And obviously doing a lot of share buyback and other things to help improve EPS to offset that. But the reason we talk about this productivity issue, we believe strongly that we need to do more in the United States to invest in our human capital. We are 25th out of 35 industrialized nations in math, science, and reading, okay? And our fastest demographic groups are lagging. And this is critical because in the age we're in with technology and technology-enabled disruption, we need a more adaptable workforce, okay? And that means early childhood literacy starts with that, improved secondary education, improved college readiness, but it also means beefing up skills training, okay? And we're doing a good job in the United States, but not nearly as fast as we need to keep up with the dramatic increase in the need for training in these middle skills positions. So we think that's one of the reasons why we're seeing productivity sluggish. Another way to say it, you've got a 160 million person workforce, 46 million of that workforce is high school educated or less. If you've got a college education in this country, you are highly likely to be employed, you're highly likely to participate in the workforce. If you've got a high school education or lower, you're highly likely to be seeing your job either restructured or eliminated. And unless you have a skill or you're willing to get retrained, which is easier to say, not so easy to do, you'll find a job in this economy, but it may well be in a job that goes from making this much to this much. So we think we've got to do more on human capital. That's second driver. Other two drivers are globalization, where the world is becoming increasingly global, financial flows, economies are more integrated. We think that's an opportunity for the United States, but the narrative in recent years has been, not just in the US, but globally, is maybe we should shy away from globalization. Globalization in terms of immigration, sensible immigration, and trade. But in a world where your population is aging, you've got the leading companies in the world, we think integrating more with the rest of the world is probably an opportunity. It's being labeled as a threat. Why? If your job is being disrupted in this country, 15 years ago, it probably was due to globalization. Today, it's probably based on our research due to technology and technology-enabled disruption, okay? But if it's being attributed to globalization, we think probably incorrectly, we're gonna make poor policy decisions which will cause us to grow more slowly. And so we flag that. And then the fourth big driver is debt. And I mentioned the household sector has been deleveraging, that's positive. Helps the consumer, good underpinning. The corporate sector, though, is dramatically more leveraged, or is more leveraged today than it was 10 years ago. BBB debt has tripled, leveraged loans have doubled, high yield debt issuance has dramatically increased. We don't think that's a systemic risk, but we think it will be an amplifier in the next downturn, i.e. if we slow more, a higher percentage of corporate cash flow is going to have to go to service debt than it's going to be for CapEx and hires. And so we think that's worth watching. But the big change is government debt to GDP has dramatically increased. We question whether that's sustainable. We just literally leveraged up a couple of years ago, late in the cycle. And we were talking earlier, a lot of this leveraging rests on the premise that the dollar will always be the world's reserve currency. We think at the Dallas Fed it is a mistake to assume that the dollar will always be the world's. I mean, people need to invest in treasuries and the dollar. And we now are running, present value of unfunded entitlements is now 59 trillion. And we're exceeding 20 trillion in issued debt. And so we think our debt growth has got to be moderated. There's a number of ways to do that. Growth, by the way, higher growth would be one of them. But our guess is we're going to need to moderate that debt growth, and that may turn out to also be a headwind for GDP growth. Those are the things we're watching. I could mention one other, which is not a structural issue yet, but we're watching it very carefully, which may surprise you: climate change. You would say, what do you in Texas? Why are you talking about climate change? Why? We've got hurricanes, Harvey most recently. We house the nation's most of its energy infrastructure, refining capability, and we're on the Gulf. And we think if you read the National Climate Estimate, the severity of these hurricanes is going to increase. Right now, the effect of most of these severe weather events, flooding and others, is transitory. But if you believe the National Climate Estimate and these events become more frequent, they may start to impact economic performance, and so it's something we're vigilant about.
Rob, we talked about growth. We haven't talked about inflation, and listen to some of your secular concerns: aging demographics, technologically enabled disruption, debt and debt dynamics. It's hard to, again, this might be a bond investor's panacea, but it's hard to envision an inflationary environment coming out of those structural headwinds.
So there's two parts to inflation, the way we look at it at the Dallas Fed. And by the way, I'll just mention, for all the talk that there's no inflation, the Dallas Trim Mean, which is our measure of core inflation, that's a fancified term for it. We X out extreme movers to the downside and to the upside. We think that's a better measure of where headline PC inflation's heading. It's running right now at 2%. Okay? So we've got inflation in this country, but we've got two components, and we don't talk enough about both. There's the cyclical element of inflation, which is what you mostly hear about: tight labor force, wage pressure, and the tighter the labor force gets, the more those cyclical forces build. What offsets that is the structural forces, which I talked about: technology-enabled disruption, globalization, which means businesses, even if they have wage pressure, they may well not be able to pass it on in terms of prices. Increasingly, businesses are getting more commoditized, and if you have wage pressure, you're just as likely to see margin erosion as to be able to pass it on. So the issue is, and I think those structural forces are intensifying. Having said that, I don't think that, so the Phillips curve, for those of you who, this inflation review eventually gets to the Phillips curve, which historically said, to the extent you had a tighter labor force, it would eventually translate into inflation. And people have noted, gee, the Phillips curve, maybe it's dead. I don't think it's dead. I think it's flattened. But I think there's still an intercept. And we're going to find out through experience, it could well be that we can run the economy hotter, the labor force tighter than we have historically, without generating undue price pressures. But there still may be a point at which you run hot enough that you still do generate inflation despite these structural headwinds. And it's this dynamic that I'd say we're learning about, and we need to be open to learning about, because it's different than it was 10 years ago and 15 years ago, because of the advent of mobile computing, the power of the consumer, technology-enabled disruption, and to some extent globalization.
So that in my mind, and maybe that's just my framework, that creates a really challenging environment with which to try to set policy.
Yep.
Because you can't, the cyclical and the secular, the time horizons are almost colliding with some of the challenges that we all face. How does the Federal Reserve, how does the FOMC respond to a more challenging environment where the undercurrents, we were talking about this earlier, if you look at the equity markets, the dispersion is growing, but that represents growing dispersion within the economy. And how do you set policy for
So I'll give you my own view on how we should go about this and how we go about it at the Dallas Fed. And the nice thing about the Federal Open Market Committee, it's a group process. It's a pretty small group, but say 15, 17 of us, depending on how many governors are in their seats. And we debate this out. We all do our own independent estimates. But way I go at this is to say, we have to look at the economic models and what they would tell us about where inflation should be heading. But then we do surveys of businesses, and I talk to literally 30 CEOs a month, and I rotate them. And then I'm watching. You've got a big dashboard, but I'm talking to businesses constantly to try to understand better this dynamic. And so you're trying to balance these forces and to try to understand with the realization how this economy unfolds. The history may give you some guide, but you got to be very careful not to assume the future is going to look like the past. By the way, that includes, even though we've had relatively sluggish inflation for the last 8 or 9 years, I also would caution us when we debate it not to assume the future is necessarily going to look like that past either, because we're running a much tighter labor force right now. But when you balance all of that out, what I try to do is figure first thing you try to do is figure out what's going on in the economy, and then the other thing we're trying to always judge is what's the neutral rate. And you may hear that, you're not going to see it on your Bloomberg screen, and I wasn't familiar with the term until I got to the Fed. The neutral rate is the theoretical Fed funds rate at which we're neither accommodative or restrictive. And it's a very important judgment you got to make, and it's very imprecise. But the reason you got to make that judgment, you have to decide, given your current stance, what's going on in the economy, what's the outlook, but are we restrictive or are we accommodative? And you're always updating that view. And my own view right now is we're in the neighborhood of neutral right now, okay? We've raised rates approximately 9 times over the last 3 years as we've been drifting gradually and patiently toward a neutral stance. And I would say the behavior of the economy, for me, up until about 5 weeks ago, was consistent with the view. What I could feel from economic performance suggests to me that we're sort of in the neutral range. So what you're trying to judge is what are the prospects for growth? What are the prospects for the job market? Do you expect it to tighten? I do. And what are the prospects given that for inflation, which I expect to end the year around 2%. And I certainly expect the Dallas Trim Mean to be around 2%. And then you're trying to judge by your conversations with businesses and our surveys, what are all the other dynamics? And then keep updating judgments about where am I right? Is our stance, are we neutral? Or are we updating our judgment? I still believe we're in the neighborhood of neutral right now.
Rob, talk a little about last fall, because you've been quite clear that we're probably close to neutral. There are others on the committee, including the chairman, who seemed to indicate that we were still quite a distance away from what neutral may have been. And there's been a pivot to a more realistic viewpoint on terms of what neutral may be. What were some of the drivers?
Yeah, so there's a convention at the Fed where the chair doesn't try to interpret what Rob Kaplan's saying, and I don't try to interpret what the chair says. And you got to understand, in the press and the way things get filtered, sometimes when I read an article about what we think or what certain people think, or sometimes what I think, oh God, and so you're always trying to communicate clearly where we are. Here's where I think we were through last fall. And let me tell you where I started seeing, probably, and you and I had talked during that time, probably around July, August, certainly global growth was decelerating. Okay, so number one. Number two, started hearing from people in interest-sensitive sectors, cyclically sensitive sectors, like housing in particular. The folks that I talk to regularly in the housing sector across the United States, a lot of my contacts are nationwide, were saying, I don't know what's going on, but something is going on because we're seeing demand fall off. Their sense at that time maybe was a little bit sticker shock, and some of it at the time, it's hard to believe because it wasn't that long ago, the 10-year Treasury was over 3%, and they thought maybe it's mortgage rates. But I was seeing some deceleration in growth in cyclically sensitive sectors. And then starting probably in around October, started seeing credit spreads widen and financial conditions tighten. A lot of people say, gee, that the Fed is very focused on the stock market. I do not. I am not particularly influenced by what goes on the stock market. And I'll give you an example. In the first quarter of 2018, we had a substantial sell-off in the stock market. Did not affect our views, did not affect our stance, because credit spreads stayed pretty well tethered. What started to see beginning in October is credit spreads started to widen. I do care a lot about that. I care about access to credit and cost of credit. And this reached its apex to where by the time we got to December, there was basically no high yield issuance in the month of December. So it seemed to me that we were on the verge of potentially a credit crunch where access to credit and financial conditions were tightening. Those three drivers suggested to me as I went into the December meeting that while we would debate, and why I was willing to increase the Fed funds rate in December, I also, my stance was going into the meeting, and I said some of this publicly, we should pause, okay? In other words, we should, at this point, pause. And I'd say what happens in the committee is there's an evolution of these various views. And so I don't see what the Federal Open Market Committee did quite as a reversal or as much of a pivot as it might have been seen, because I've been in the middle of the discussions. But I would say our position evolved where by the time clearly we got to January, and with those three drivers I talked about, global growth decelerating, cyclically sensitive industries showing weakness, and credit conditions tightening, and I feared severely tightening, it made sense to pause and telegraph to the public that we would take no action for some period of time. And that was the evolution that I saw, and it may have been reported differently. But if you actually, one thing I'd recommend to you, if you had the time, I do this. I read every Fed president's speech, and I read every governor's speech. Not many people do that, but I've only been at the Fed about 4 years, so I do that. If you read all those, you get a very clear picture where people are coming from, and it's very reflective of the debate in the room. But most people don't do that, right. And they might take a snippet from something I say or others, and you don't always get a clear picture. But that, I would say, the debate evolved through the fall and until we wound up in January with a pretty clear signal that we ought to pause, and that's where we have been up until recently.
So market has taken pause and has begun to price in ease.
Yep.
2 or 3 priced in for 2019 or into 2020. What's your sense of what the market is pricing?
The only comment I'll make on the market, having been in the markets for a long time, is the only thing I know. So I always want to watch what the markets are saying. I'm very carefully, always again, looking at credit spreads, financial conditions. Shape of the curve means a lot to me. But I'm also cognizant of the fact that the markets can change on a dime. Mm-hmm. And we've seen it recently. Since May 1st, in the last 5 weeks, you've seen a real dramatic change in the shape of the yield curve and the level of rates. And I think primarily because of heightened tensions and fears that this will slow growth globally, and that may in turn lead to slowing of growth in the United States. And so my only comment is, given this recent deterioration has been so recent, my own belief is it would make sense to let this situation breathe a little bit, in that some of the decisions and announcements that have been made over the last 4 or 5 weeks, some of these decisions can change. And we may see new announcements and new decisions on the next 4 or 5 weeks. And so my own view is I'm concerned. I think risks to the downside have increased. But at this point, I think it's too soon to make a judgment about whether there's any action that would be appropriate as a result of that. I want to take more time and watch this carefully, but I'm watching it very carefully. I'm very vigilant about what's going on, but I want to give this a little more time and let these events unfold, given how recent this recent heightening of trade tensions has been.
You mentioned the yield curve. Talk for a moment about your interpretation of the flatness of the yield curve.
So
You and I spent a lot of time talking
yes.
about this.
So what the punchline is, what the yield curve says to me is expectations for future growth are sluggish. That's what the yield curve tells me. So we've got a 3-month bill today at, in the mid 230s. You've got a 2-year and a 5-year in the 180s, 190s, and you've got a 10-year at 210, and the whole level of the curve has come down. And it basically says, in light of what's going on out there, there's a concern in the bond market that expectations for future growth are more sluggish today than they were even a month ago. I worry. I'm one of the people at the Fed who has said, I do think an inverted yield curve is a significant thing, but I need to see that inversion have some size and some duration. And in terms of what do I look at? Yes, I look at 3 months to 10 years. I look at 2 years to 10 years. I look at all these elements, and I'm watching this very carefully. And why does an inversion matter? Particularly if it's of some size and some duration, lasts for a while, is it ultimately, in my experience, in my view, will impede the ability of financial intermediaries to create credit. And as you've heard from me, on financial markets, the thing I'm particularly watching is financial conditions and the ability of businesses to get access to credit. And if you can't borrow short and lend long and make a spread, or that relationship becomes a little bit distorted, history has shown it is likely to cause ultimately a tightening in financial conditions. And if financial conditions tighten and stay persistently tight, that tends to create a slowing in GDP growth. So I'm watching this very, very carefully, and I'll continue to watch it carefully.
We've talked about interest rates with regard to policy. The other element of monetary policy has been the balance sheet. Can you talk for a moment about the balance sheet runoff, the end of the balance sheet runoff, reinvestment of proceeds to the extent that you have views?
So for those who've been watching this, the size of the Federal Reserve balance sheet in 2007 was about $800 billion. Primarily treasuries, by the way. The balance sheet reached its height at about $4.5 trillion, which was made up of approximately 65% treasuries and the remainder mortgage-backed securities, which came as a result of several rounds of quantitative easing, which occurred after the Great Recession. We made a decision now about 1.5 years ago that we, as a group around the table, we did an enormous amount of work, and after many months of deliberation, we started a process of allowing the balance sheet to run down. And when I say run down, we didn't actually sell treasuries or mortgage-backed securities. What we did is developed a plan where as these securities matured, we just wouldn't replace them. So we allowed them to run off. We are today so the balance sheet today, as this runoff has continued, is about $3.9 trillion. We have announced a couple of 3 months ago that we would end this runoff early September, at which time the size of the balance sheet is going to be somewhere at $3.6 trillion. So why is the balance sheet so much bigger than it was in 2007? Part of the reason is demand for reserves has gone up dramatically. Some of that is cash and currency in circulation. Some of it is regulatory related, in that we have much tighter and tougher regulatory requirements, which cause the banks to desire to hold more reserves, leverage requirements and other. And so we will then manage the balance sheet after September based on what we think the demand for reserves is, and we will manage the balance sheet accordingly. But that's where we are on the balance sheet rundown.
Can you talk a little bit about the toolkit going forward? So, starting point for Fed funds is roughly 2.4%, 2.5%. Balance sheet is larger than it has been historically. Outlook for the economy is still fine, but there are obviously downside risks. Mm-hmm. Not anticipating, but in the next downturn, what does the playbook look like for the Federal Reserve?
So let me make 2 or 3 comments on this. We'll start with the basics. We have 3 primary tools at the Fed. The federal funds rate, the balance sheet, i.e. in the form of things like quantitative easing, asset purchases. And then the third tool, I would argue, is forward guidance. In other words, saying what we're going to do in advance of what we do it, which I think can have a powerful effect. You could even argue what we said in January is that I argued we should take no action for a couple of quarters. That's a form of forward guidance. That can have a powerful effect because people are judging not only where are you, but where are you going. So those are still the 3 primary tools. There have been a number of arguments that have said, gee, in previous downturns, the average Fed funds rate reduction has been several hundred basis points, and with the Fed funds rate today at 2.25, 2.5, you don't have as much firepower. And so in my role as a central banker, I always have in the back of my mind, and I have had since I got in this job, that the Fed's tools at this stage are somewhat asymmetrical. What do I mean by asymmetrical? It's easier to tighten than to ease. You know, with rates this low, we know how to tighten, and we got plenty of capacity to tighten. But with this toolkit, it's more challenging to find ways to ease monetary policy. That is a factor in my thinking as I think meeting to meeting about actions we should take on monetary policy, because I understand that our tools are somewhat asymmetrical. Has to be a factor. I'd say a third thing. In the last 10 years, we've sort of gotten used to the idea, that monetary policy is the primary economic policy in the United States. When there's an issue, people look to the Fed as to what are you going to do. If I roll back over a broader time frame over the last 75 years, we normally think about economic policy as monetary policy and fiscal policy, and then you've got a bunch of other structural decisions you could make. So what's an example? Immigration reform is a structural decision. Improving spending on early childhood literacy is a structural decision. Skills training is a structural decision. Spending on infrastructure, which we think we're about $3 trillion underspent, that's a fiscal policy, maybe quasi-structural decision. And I've been saying ever since I got in this job, while obviously as a central banker, I think monetary policy is very, very important as a key role to play, we need to increasingly broaden our thinking about economic policy in the United States and think more about monetary policy, fiscal policy, and structural reforms, because if we're going to grow faster, especially given the structural challenges I talked about earlier, monetary policy has a role to play, but monetary policy alone will not be enough to deal with those structural issues. We need structural reforms. And this is why on almost every speech I give, I talk about these structural drivers and the need for these structural reforms. And I meet with elected and appointed officials locally, in the state, and in the country, because we probably need to address some of these structural issues if we're going to be more effective and grow faster and have a healthier, more prosperous economy in the future.
Quick question. Others have employed negative interest. Other central banks around the world have employed negative interest rates. In fact, I think the current statistic for global government bonds is $11 or $12 trillion in notional of government bonds that have negative nominal yields. Would the Federal Reserve ever entertain the concept of negative short-term interest rates here in the United States?
So in any monetary policy, and we just had a Federal Reserve conference in Chicago. Yep. You won't go to a monetary policy conference where the subject of negative rates doesn't come up. And I think it needs to always be an option. My own view is I'd be very reluctant in the future to pursue that option. Why? Because I think the impact of negative rates is going to have probably a very challenging impact on financial intermediation, credit creation, on savers in an aging society. If you've got negative interest rates and probably the danger and incentives that creates for greater risk-taking, excesses and imbalances that could come up. So I'm very hesitant about in the future wanting to use that tool. Having said that, you're not going to hear me or others dismiss that tool. It has to be something we look at, but I'd be very reluctant in the future to want to use it.
Good. We'll transition to questions from the group in a few minutes, George. That's okay. Eager bond manager. But just as people think about questions, and George will get the first one, just a few.
It's only 4 minutes, according to that.
4 minutes and 19 seconds, 18 seconds. Just sort of a few questions on away from sort of policy.
Yeah.
Here we are at BC. If you have 1,200 bright folks working for you at the Dallas Fed, I'm sure you have access to all the research you could possibly get your hands on. If there were one research project that you could commission, what would it focus on? So,
and you know, the way we work at the Fed, by the way, so I run the Dallas Fed, but the nice thing about the Fed is I work with all the other presidents on a number of other things. So I chair technology system-wide for the Fed. I chair the whole budgeting process for the Fed system-wide. So we do a lot of things that are integrated. And so what I would, so why do I mention that? I'm always going around talking about leadership at the Fed, and I'm asked to do it a lot. And so I talk a lot about vision, priorities, and alignment, making sure we're open to learning. If I had one research project or area of research I'd like to see more done on, I'd like to see more research done on the impacts of technology and technology-enabled disruption. And that's a tough area to research because it's a recent development and there's not great data. And I would love to see more research on the impact of improving early childhood literacy. I'd love to see the impact of improving skills training. I just saw a research paper which I was very impressed with, but it's one of the first ones I've seen on skills training and its likely impact on GDP growth. I think in the world we're entering into, which is much more of a technology, information age, where adaptability of the workforce is going to be far more critical, and most of the graduates of this school are going to be more likely to change jobs, change careers, and see more disruption. I think do more research on adaptability, improving investments in our human capital. That's probably the number one thing I'd like to see more research on.
You've had leadership roles in the private sector.
And the reason I want to see more research on it, I think the extent you've got good data, you can be more persuasive in convincing policymakers to take action. Yeah, go on.
Just on the leadership front, you've had leadership roles in the private sector and the academic community, and also, you know, although Federal Reserve Bank of Dallas is a private sector entity in a governmental public sector setting, does it take different skills leading in those three different theaters?
Yes, it does. And the reason it does is the cultures, listen, the culture among, you take 20 different companies, the cultures are different. And for most of you know, the first thing you got to do when you're a leader as a company, you better understand the culture of that company and that industry. And by the way, you can be at the same company for 20 years and the culture of the industry and the company is going to change, you've got to adapt. But I assure you, the culture of Wall Street firm, or the Wall Street firm I was at, the culture of Harvard Business School and the way you get things done there is dramatically different than the culture of being in the business world. And the culture of the Fed is, again, dramatically different than those two. I think the stop at Harvard was very helpful to me, because a lot of the techniques I learned to get things done in academia have served me well at the Fed. But one thing they all three have in common, and I use this approach, you have to think through what you're doing that's distinctive. How do you add value that's distinctive? And I'm sure the dean here, in talking earlier, is thinking about this business school. What do we do that's distinctive now? Is it going to be different than what we did 10 years ago? And if it's the same as 10 years ago, we're going to be in trouble. What should our top 2 or 3 priorities be? And I've learned, of anything at the Fed, and I give this advice to people, if you want to get something done at the Fed and you're trying to get 5 things done, you may get nothing done. If you have 1 or 2 things you're trying to get, you got a hell of a chance to get 1 or 2 things done. You got to prioritize. And then you always have to be thinking about where you're out of alignment, okay? You're always out of alignment based on your priorities. And that analysis served me well in business, it served me well in academia, and it definitely serves me well at the Fed it's a good framework to use.
This is grossly self-serving since I have a daughter that just graduated high school, but if you were to give an 18-year-old advice, given sort of your secular thinking and the challenges, what would you tell them to study and what would you tell them to pursue from an industry or career perspective?
So that's easy enough, because I would say two things, and I wrote a book on this, as you know, in addition to the strategy stuff. First thing, be able to write down on a piece of paper your strengths and weaknesses. And most people can't, including people in this room, by the way. And the reason you can't is because we all have blind spots. You're going to need to get advice from people that observe you to be able to write down your strengths and weaknesses. And once you think you got it, it's going to change 3 years from now because the world changed, your job changes. So, and then second, what's her dream? What's your passion? Passion is the rocket fuel that drives high performance. The trick is to find a job that fits your strengths and weaknesses and your passion. The peer pressure has never been greater. Teaching, and people are doing things, they don't even know why they're going into these areas, but all their friends are. And you gotta help people resist it. And then the last thing I'd say, which I'm shocked about, read the newspaper. If I were giving her another, read the newspaper every day. And I've been amazed how few people read the papers every day. To me, it helps to hold it in your hand because you can flip. Read it, and don't just read the most popular stories. Read the papers every day. It is an enormous advantage if you know what's going on in the world, and I've been amazed by what percentage of people out there at all stages in their career, but young people are not reading the paper every day. The loss of the printed paper is reducing the probability that young people are reading it, and that's a mistake. And I say in groups, if I just gave you one piece of advice, that would be the only thing I want you to remember. Read the paper every day.
And call your mom.
Yeah. Well, relationships matter. The other thing I've learned about this generation, which I was surprised at Harvard, is they're more isolated than we were. Now, why is that? They got 1,000 followers, 1,000 connections on Facebook or Twitter, whatever, or Instagram, but that's not a relationship. Relationship means you got somebody you can talk to, who you trust, who understands you, and that can only be done face to face. And I found that technology is squeezing out face-to-face relationships. And I've been amazed when I was a professor at Harvard, the percentage of students who, when they're in a pinch, they got no one to talk to. They got 1,000 contacts, but they got and they're networked, wow. But they got no one to talk to because they have not, all this networking is squeezed out face-to-face relationships. If you've got 3 or 4 relationships, you're doing well. That may include your mom, calling your mom, but this generation is far more isolated, which means peer pressure is a problem, and it means when you have an ethical dilemma, you're far more likely to make a terrible mistake, because if you're isolated, you're going to make very poor decisions at critical times.
It's all great advice. George, you've been patient. We'll give you a chance to ask your question.
Thanks so much.
I think there's a microphone coming if you want to hold on 2 seconds longer.
Thanks so much, Bob. That was all fascinating. And I hate to take you back into the nitty-gritty of your day job, but
that's where I live.
Early in your talk, you emphasized heavy credit growth, triple B credit, corporates, et cetera. Later in your talk, you said you're really focused on credit spreads. And I can't help thinking that, like, you're focused financial conditions, but credit spreads in particular you mentioned.
Yeah, I am. Access to credit.
And so I can't help thinking that there's a circularity here, where you're focused on them and they're focused on you. And part of the reason they borrowed all that money and lent all that money in the last decade was complacency about interest rates, that the Fed wasn't going to do anything to choke off this, weak recovery, and therefore, why wouldn't we lever the balance sheet more? And so now we're at a state where we have enough credit outstanding to worry about. Anyhow, what do you say to all that?
So if you follow my speeches, you'll hear me say almost every single time, accommodation is not free. Okay, and when I say accommodation means running persistently low rates or being accommodative and running rates persistently low has the danger of creating excesses and imbalances if they go too far, which are going to create a problem in the future, which if the Fed has to take action to deal with, may cause a very severe downturn. So it is a fair criticism, in my view, or comment, that this long period of rates running very low and a period of low rates, and for a lot of it accommodative, has encouraged debt buildup. And when I'm around the FOMC table, I comment to the group, if rates stay persistently low, this credit issue is likely to get worse. And why? Because it's so accretive to use debt to buy back your stock or for other activities. And so it's a factor that I want to be mindful of at all times when I'm thinking about monetary policy. My own view is, the only good news is, I don't think this is not big enough or bad enough to become a systemic risk, but at this point it is significant enough to be an amplifier in a downturn, and it is something I think about when I'm thinking about monetary policy, and it's one of the reasons why, while it wasn't easy to try to normalize monetary policy, I thought it was important to be taking steps to do it, but it's a challenge with the environment that we're in.
Rob, let me just build off of George's question for a second. You talk about credit spreads, you talk about high yield issuance in the primary market, but that's the large and the liquid. And it's only it is by numbers, a small percentage of what drives the economy. It's the small and medium-sized enterprise that in many regards, since the financial crisis, has been shut out of the traditional lending channels. Or that's a bold statement. That might not be right.
So let me talk about the whole ecosystem. So, and we'll take them in pieces. I've been a strong believer that for the big banks, and I can say this, I worked at a big bank, and I was the board of another big bank. I think capital requirements should be very tough, and stress testing should be very tough. And while there may be some streamlining should be done, I'd be very careful and loath for us to go too far. Having said that, on small, mid-sized banks and community banks, I think, unfortunately, we need much more regulatory relief there. And I was about to say, unfortunately, because some of the rules for the big banks have been applied to the small banks, it's made it harder in many communities for people to get access and small businesses to get access to credit. So and then the small banks have all the other issues they're dealing with, being disrupted by fintech, et cetera. And I'm worried about the steady drop in the number of small regional banks that can serve small business. So that's one part of the ecosystem. The fact of the matter is, in my career, and we were talking about this earlier, the normal advice I'd give to a client is finance when you can, and if you have an opportunity to deleverage. Mm-hmm. Because we've had approximately 10 years of an expansion, and we've had pretty good, with some interruptions, but not long, we've had pretty good access to capital for a very extended period of time. What tends to happen in those periods is people forget that advice, thinking we'll always have access to capital at very attractive rates. This is if you have access to the financial markets. And I think that may not always be true. And what's more normal in my career is you go through periods where you don't have access to capital. We just haven't experienced that in a while, and my worry is when we do, it's going to be very traumatic. And so the danger is the more debt in these good times that gets put out there, and the fact that we've got somewhat less liquidity because of the Volcker rule, which we could debate separately, and other issues that may be creating less two-way flows. In stress periods, I do worry whether there'll be some strain and what'll happen to financial conditions during those periods. And it's something I just have to talk about, and we're watching very, very carefully.
Wow, that's a lot to choose from.
Hi, on the supervisory side, is the Fed looking at markups that you mentioned community banks that some smaller investors are paying, and maybe recommending that they do some kind of transaction cost analysis to improve profitability and strengthen controls, which is something that larger asset managers have been doing and consider a best practice?
So you're talking about markups of what?
On securities transactions when they're buying and selling bonds, markups that the banks are paying brokers.
I haven't gotten into that level. When I look at small banks, what I'm trying to figure out is, do they have enough capital? Where are they where are they investing? What are they doing with their excess deposit account? Probably I wouldn't get to that level of granularity. Probably in my job, probably leave that to other agencies to bore in on more.
But do you know if the Fed is doing that in their supervisory areas?
Our main concern is safety and soundness, and we might be of the view that there are other agencies, SEC and others, that are probably more appropriate to look at that.
Thank you.
I'll let you with the mic decide. Yeah.
You expressed a concern about the dollar at some point losing its status as the
I don't expect that to happen, but I don't expect that to happen. I don't see it happening, but it pays to be cognizant.
Yes, and I would just like you to continue that thought about how that would roll out and what would be the tools available to deal with that. Would we get into sort of a stagflationary situation?
Well, okay, so I don't know about that, but so people ask me all the time, what do you see as a black swan event, that could happen? And so I'll just give you, and before I answer it, I always say, let me give you my definition about black swan event. Black swan event is not the thing that comes out of nowhere. The black swan event is the thing that's staring you in the face, and it's so obvious, and it's so much staring you in the face, you willfully choose to ignore it, okay? And then when it happens, you're like all shocked that this thing that had been staring you in the face for so long, and I would say the amount of federal government debt, not just the amount that's issued, but also the present value of unfunded entitlements, that's the thing that's staring us in the face, and we are willfully ignoring it. So then the question is, why are we doing that? Rational society, it's because we assume the dollar will always be the world's reserve currency. We may not be conscious that's what we're doing, but that's what we're doing. We're saying we can finance it. And I see a lot of people I think highly of prominently arguing, I think too much worry about this, we'll always be able to finance it. We will if the dollar continues to be the world's reserve currency. Now, I think for the next X number of years, that's likely to continue. But will it continue for the next 20, 25 years with technology, other changes, trade tensions, if that ever changed, and if we had to pay 100 basis points more for our debt, times $20 trillion, that's $200 billion a year. That's a lot of money. And plus, before we even get to the entitlement issue, and so my only comment from that is I usually think it's a mistake to willfully assume an issue away. And from a risk management point of view, it strikes me that it would be prudent to do some things to moderate our debt growth. That could be higher growth, could be entitlement reform, could be focusing on a number of other things. But why does this matter? I think if you're going to talk, immigration is a very sensitive topic. And we, by the way, at the Dallas Fed do a lot of work on immigration, and we publicly said we think the U.S. immigration system would be well served to be more skills-based and employer-based, more similar to Canada. But that debate is a different debate. If you're extremely highly leveraged, you might be having one debate about immigration because it's critical to workforce growth. And if you're not highly leveraged, you could have a different debate about it. But we think we should be having these debates reminding ourselves we're very highly leveraged and not willfully ignoring it.
Yes, sir. Right there.
I want to just say that I'm really, really happy for your thoughtfulness. I wasn't sure that people on the Fed thought like this or thought so broadly, but I want to raise a question if you've thought about this topic. And I'm coming at it from the perspective of working in technology industry all my life. And I would say over the last 20 years, I would say there's more and more corporate short-termism, McKinsey defines. Mm-hmm. I worked in 3 research operations where our budget was declined every single year over the last 20 years.
Yeah.
I would juxtapose that to the investment that China is making in AI, where they're really ahead of us. I think that's pretty well understood. What do you think about changing that whole practice of it's all about the next 90-day stock price and earnings per share? It seems that's a big underlying piece of where we're going to go.
It is. So I sort of bring into the discussions, this relates somewhat to corporate debt. So activism, I used to do raid defense for a lot of my career. I was an investment banker for a long time and advised a lot of companies. There's never been more shareholder activism than there is today. It's unusual for me to talk to a CEO today that if they're public, that doesn't have an activist in their stock, okay? And what's a typical playbook by an activist? You got to do things to grow. You got to grow your earnings per share. Gee, why don't you? You got balance sheet capacity. You should leverage. It tends to be very short-term oriented, and that shareholder may well not be in the stock a year later, by the way. And so the pressures on companies today to grow, given they've got lack of pricing power, they've got margin erosion. And so I mentioned about even in the oil business, but I could go through every single industry. I mentioned long life projects. They're not spending on them. They want to protect their dividend, and it's too risky. But that's going on broadly, and there's more likely companies are using their resources to borrow and do share repurchase. And it's not the Fed's role to come up with a solution for that, but I do think it's part of my job to talk about it and acknowledge it and flag it because it's having an effect on CapEx. It may ultimately, depending on how the economy unfolds, have an effect. This is why I hate to see more sand in the gears of logistics and supply chain arrangements, because it was one of the few levers companies had to be able to manage this dynamic. And I hate to see that imperiled. So right for now, I'm talking about it, and I think about it as I think about the role of monetary policy.
And to be fair to some of the things that you just said, the bond market could be a better governor of itself in terms of being more skeptical in the willingness to lend money to companies for share repurchases, for buybacks, for egregious activities. But we're not, or it's not, which is a...
That's what makes a market.
That's what makes a market. John.
Again, thank you for being here. Great discussion. I want to go back to what you said, and this is actually a question for both of you, about your concerns around the inversion of the yield curve and how intermediaries may shut down and stop providing credit. Was that, did I get it?
They won't stop. Here's all that happens. It's a little more subtle than that, in my opinion. And you'll notice the history is shown, and I've studied, because I've had to in this job, every inversion that we can find data on. And normally it doesn't go like that. It usually there's a 18-month on average lag between an inversion of a certain, and if the inversion just lasts for a few weeks, it doesn't have much impact. If a persistent inversion, usually 18 months, and what tends to happen, it's not that credit creation goes from here to here, it just means it's harder. It puts more sand in the gears of the ability to create credit, and ultimately what's eventually happened is credit's gotten tighter. And so a lot of people, here's why I've mentioned this. A lot of people argue this is a signal, but without a fundamental impact. I'm not as interested in the signal. I'm much more interested in the fundamental impact. And I think there's a fundamental reasons inversions historically have been a pretty good predictor of a future recession. If they go on for long enough and they're of sufficient size, it makes sense to me.
Does the shadow banking system that Mark is on does that play a role that, the shadow banking system and what's emerged as access to credit that maybe wasn't possible 20 years ago in the last recession, is that going to play a role this time? Is it different? Is that something you're looking at?
I don't know. It's the same issue. If you look at the shadow system, most of their access is, same thing. Borrow short, lend long. I think it creates a challenge.
There's a question right there.
Hi, Robert. Thank you. So first, I just want to say that very familiar with the Houston market. I actually lived on Allen Parkway, about 2 blocks from the Federal Reserve of Dallas. So my question is a 2-part question on the oil and gas industry. You discussed a little bit about oil companies shifting away from their investments in longer cycle projects. Is that a short-term response to kind of the 14-15 oil crash in price, or is that a longer-term trend in the industry? And then the second part is, where do you see the most growth potential in that industry?
So, I'll tell you 10 years from now, which it turned out to be on these long life projects. For the moment, the big oil companies are committed to to maintaining their level of dividends. And these long life projects, by definition, are riskier. And by the way, if you're going to do a long life project, the break even is higher, and you have to have confidence for longer as to what the price of oil is likely to be. And I think a lot of these oil companies have simply said, maybe somewhat traumatized by the recent downturn, we'd rather put our resources in more nimble, bite-sized investments in shale. And now the other thing you're seeing going along with that, by the way, is people in shale, because of this rapid decline curve, are starting to say, you know what, we need more scale to do this business because we're drilling all the time. We're not generating any cash flow, and so you're seeing more merger activity. I think if you're in a shale operator, as the saying goes, contacts are telling me, you're either buying or you're selling, but you're not standing pat. As to where the future is, there's a lot of innovative work being done by a lot of these energy companies on battery storage. A lot of investments being made. Texas, people don't realize, largest wind producing state in the country. You see a lot of investment there, a lot of people working on solar, but the big thing in particular, which could be a breakthrough people are working on, is battery storage. So why is that so important? If solar is going to be a viable alternative, you got to find a way to store the energy. Now, having said all this, all of our work suggests, assuming aggressive growth, and I mean aggressive growth in alternatives, by 2040, something like still 75% of the world's energy demand is going to be fossil fuels. Okay? So that's if you assume aggressive growth in alternatives. So fossil fuels are here with us for some extended period of time, but there's a lot of work being done, surprising amount of work being done on alternatives, and I think that's going to accelerate, I would think.
Yes, China. I believe the trade thing is really about the future of warfare. It's not about soybeans. Could you just try to put trade aside? What is the status of the Chinese economy? What structural issues are at play there?
So we're in put it a different way, we're in a global competition that's going to go on for the rest of our lives and into our kids' lives with China. And I mean global. They're competing, they're trying to set their standards in parts of the world away from our standards. And this is, what's going on right now is symptomatic of that global competition. China's growth, they've worked hard to peg, they would reject this, but I'll say it, to sort of set their growth in advance at 6.5% a year, and they've used leverage, not just the government sector, it's state-owned enterprises and municipalities, to invest in CapEx, or infrastructure, I should say, and state-owned enterprises to try to meet 6.5. They've recently given some indication, and they've been talking for the last several years, we can't keep doing this. We can't keep using leverage to grow. And so I go there once a year, my last several visits have been mostly about, we need to tighten our clamps on the shadow system, we need to be much more careful about leveraging up, we're going to have to let GDP float, politically we're not sure how to do it. That all was the case until my last visit, which was first week in May. And what I heard there is, maybe we should be more willing to use government debt to fuel GDP growth. Maybe we should ease off on the tightening, and they have, of the shadow system, and we've done our work, we serve the purpose, we need to encourage more credit growth. And so what I learned there, the growth there is weaker, okay, than it's been, even though the headline number may not have changed, the PMI surveys are somewhat weaker, and I saw a much greater determination to do what is necessary to continue to grow and to stimulate growth. That is a different tone than I heard from the last few years when I visited.
Desperation?
No, not I would say determination is what I heard. And so you remember, this is a country that has probably overspent on infrastructure, is spending heavily on 5G, is spending heavily. I talked about education. I don't need to talk to them about education. They are spending heavily on their human capital, okay, and trying to stimulate domestic demand. I saw a far greater determination to do what they need to do to continue to grow.
All right, I think we have time for one more question.
So earlier you mentioned globalization kind of as a perceived threat when it really is technology and the possibility of that causing voters and the public to kind of gun for legislation.
And to put it clearly, I think globalization is an opportunity for the United States, not a threat.
But it's perceived. And then you also
That's
talked
right.
about the disparity between the highly educated, the college
That's
educated,
right.
and the high school. How do you penetrate and educate those uneducated when half the time the materials we put out are considered elitist and oftentimes disregarded?
So there's an enormous amount of progress, and I see this in Texas, because we've got this problem significantly in the state of Texas. For all the good things going on in Texas, lagging education, U.S. lags the world, Texas lags the U.S., okay? And I'm very pleased. We do a lot of work with the governor, lieutenant governors, mayors, leading business people who have united to say we got to do something about this. And so I just gave the graduation speech Sunday for a new high school, Cristo Rey. There's a number of Cristo Reys in the United States. This is their first graduating class. There is a lot of work being done that's adapting, either 0 to 5 literacy, reading to child. This is not technology. This is not materials. This is you just read to a child 0 to 5, and reading programs, expanded pre-K, expanded Head Start, improved secondary education, improved teacher pay. These are all the things we're talking about in our state. And so what I've learned about education and skill training is it's got to be done locally, okay? And it has to be adapted to local populations. And I see that being done extensively, not just by governments, but by nonprofits and by local schools that are being, some newly created, some being restructured. The only complaint I have or challenge I have is it's not happening fast enough to keep up with the dramatic change in technology and tech. But it's happening. There's no doubt it's happening.
But how do you educate the aging population?
So that's a different challenge. My concern is reason I'm starting with 0 to 5, a shocking percentage of students you can start first grade behind grade level. And studies show if you start behind grade level, you never catch up. So we got to start, that's the surprise to most officials I talk to, got to start sooner, okay? For later, I think there's going to be more of a culture in this country of lifetime learning, lifetime re-education. There can't be a stigma with it. And also, a lot of people hate to leave their job or take time off from their job. We have to make it easier for people to stay in their job and get re-educated. And by the way, what goes with this, transportation to get to work and expanded childcare so people can, go to a job and, and so we've got to do all those things to improve the whole ecosystem. And my big concern is it's happening, but I think it should be the headline in the national discussion. We should be hearing about it every week, and I don't hear about it much, okay? Locally, we're doing a lot to lead the discussion at the Dallas Fed and convene groups. I want to see more discussion because I think it's critical to future GDP growth. I'm not doing this stuff because it's nice. I'm doing it because we're going to have higher GDP.
Thank you.
We have a 10-minute break, and then we're back for a panel on investment insights. But please,
Thank you.
Well,